Welcome to the MLO SAFE Test Study Guide. Welcome. This presentation is designed to help you prepare for the MLO SAFE Test, a key exam for mortgage loan officers. We will walk through the essential topics, tips, and strategies to ensure you're well equipped to pass the exam with confidence. Whether you are new to the industry or looking to brush up on your knowledge, this guide will provide valuable insights and resources to help you succeed. Let's dive into the core concepts and important details of the MLO SAFE Test. Conventional loans are just regular loans that aren't backed or insured by any government agency. The biggest thing to note is that these usually require a higher credit score and a larger down payment compared to government-backed loans like FHA or VA loans. If you're someone with a solid credit score and can afford a bigger down payment, this might be a great option for you. Now, when we talk about conforming loans, these are conventional loans that follow the guidelines set by Fannie Mae and Freddie Mac, which are basically two big players in the mortgage world. These loans go through an automated underwriting system, AUS, which helps decide whether you're eligible. If you qualify for one of these, they tend to be easier to manage because they follow standardized rules. On the flip side, non-conforming loans don't follow Fannie Mae or Freddie Mac's guidelines. This is where we get into things like jumbo loans, which are for much larger loan amounts than what the government agencies will back. You also have Alt-A and subprime loans, which are a bit riskier and come with their own sets of challenges, but they can be an option for borrowers who don't meet the standard criteria. Jumbo loans are the big ones, loans that exceed the typical conforming loan limits set by the Federal Housing Finance Agency, FHFA. In 2021, the limit was $548,250, but this can vary depending on where you're located. These loans are for expensive properties and come with stricter requirements like higher credit scores, larger down payments, and lower debt-to-income ratios. Because they're not backed by Fannie Mae or Freddie Mac, lenders consider them riskier, so the interest rates are usually higher too. Alt-A loans fall somewhere between prime and subprime. So, they're a little more lenient on credit than prime loans but not as risky as subprime loans. If your credit isn't perfect but you still want to get a loan, this might be a good middle ground option. These loans also tend to have more relaxed documentation requirements, so you might not need to prove everything about your income. Now, subprime loans are for borrowers who have poor credit histories. They come with a higher interest rate because they're riskier for the lender, and the likelihood of default is higher. Often, these loans will require less documentation, which is why they're sometimes referred to as no-doc loans. But, keep in mind that these loans contributed to the 2008 financial crisis due to the high number of defaults. Let's take a quick look at how these loans compare. Conforming loans have the highest credit requirements but the lowest interest rates, so they're considered low risk for both the lender and the borrower. Jumbo loans have the highest credit requirements and the highest interest rates due to the larger loan amounts and higher risks involved. Alt-A loans fall somewhere in between, with moderate credit requirements and interest rates. Subprime loans, on the other hand, have the lowest credit requirements but come with the highest interest rates due to the high risk involved. To sum it all up, conventional loans are great for people with strong credit and enough for a solid down payment. Jumbo loans are for expensive properties and require excellent credit but come with stricter conditions. Alt-A loans are the middle ground, perfect if your credit isn't perfect but you still want a loan. Subprime loans are for those with poor credit, but they come with high interest rates and a higher risk of default. So, depending on your credit score and how much you can put down, there are different options available, but you'll want to choose the one that fits your financial situation best. The secondary market is a marketplace where existing mortgage loans and the right to collect payments from borrowers are bought and sold. The purpose of this market is to increase liquidity in the mortgage industry, allowing lenders to replenish their funds and continue issuing more loans. Key players in the secondary market include Fannie Mae, which was established in 1938 to help increase market liquidity, and Freddie Mac, which was created in 1970 with the same goal. Ginnie Mae, established in 1968, is responsible for guaranteeing government-insured loans, like those from the FHA, VA, and USDA, and it also issues guarantees on bond pools comprised of these loans. The Federal Home Loan Bank system also participates in the secondary market as a government-sponsored entity. Private investors also play a role in both government-backed and non-conventional loans. Now, let's talk about FHA loans. These loans are insured by the Federal Housing Administration and come with some pretty attractive features. They require a lower down payment, sometimes as low as 3.5%, and have more flexible credit criteria. They're also easier to obtain than conventional loans because they are HUD insured and can be processed with a direct endorser status. FHA loans have different types, including the 203B loan, which is a fixed-rate loan with a 30-year term, and the 203K loan, which is a rehabilitation loan designed for home repairs or improvements. There's also a special 203K loan program for public service professionals like teachers, firefighters, and police officers. FHA loans are evaluated based on the 4 Cs of underwriting: credit history, capacity to repay, cash assets, and collateral. To qualify, you can't have federal debt or judgments, and you need at least a 3.5% down payment, which can be a gift. The front-end debt-to-income ratio is typically no more than 31%, while the back-end ratio should not exceed 43%. There's a late fee of 4% for missed payments. FHA mortgage insurance is another important element. There's an upfront mortgage insurance premium, UFMIP, of 1.75% of the loan amount, which is required, and then there's an annual mortgage insurance premium, MIP, which is less expensive than private mortgage insurance, PMI, but still something to consider when budgeting. The limits for the MIP vary by county. FHA also offers a streamlined refinance option, which is designed to simplify the refinancing process for existing FHA borrowers. With a maximum loan-to-value ratio of 85%, less documentation is needed, and an appraisal may not even be required. FHA loan limits are calculated based on 115% of median house prices in the area, subject to a floor and ceiling limit. These limits are updated annually and are based on the metropolitan statistical area and county. Moving on to VA loans, these are guaranteed by the Department of Veterans Affairs and are available to veterans, active duty service members, and certain military spouses. The main advantage of VA loans is that they require no down payment, which is a huge benefit for qualified borrowers. The terms and interest rates are also favorable, making these loans a great option for military personnel. The VA guarantee is 25% of the loan value, and to qualify, borrowers must have a Certificate of Eligibility, COE. Loan limits are based on the borrower's entitlement, which is $36,000 for full entitlement, but lenders can lend up to 4 times the entitlement amount. There is a funding fee, which is 2.3% for first-time use and 3.6% for subsequent use, though this fee can be financed into the loan. VA loans have a debt-to-income ratio limit of 41% and a notice of value, NOV, also called the Certificate of Reasonable Value, CRV, is required for the appraisal. The NOV is underwritten by the Lender Appraisal Processing Program, LAP. Closing costs for VA loans are typically low, around 1%. For those looking to refinance, the VA offers the Interest Rate Reduction Refinance Loan, IRRRL, which has a maximum loan-to-value ratio of 90% and a funding fee of just 0.5%. This option requires no appraisal or cashback options, making it a great way to lower your interest rate without a lot of hassle. Lastly, USDA loans are guaranteed by the U.S. Department of Agriculture and are designed to help rural and suburban homebuyers. These loans offer 100% financing, which means no down payment is required. The loan is typically a 30-year fixed-rate mortgage, and the borrower must meet income limits, 115% of the median income for the area. To qualify, the property must be in a rural area with a population of 35,000 or fewer. USDA loans have a 90% guarantee by the USDA, and like FHA loans, they also have a late fee of 4%. When comparing government-backed loans, FHA loans require a 3.5% down payment and are great for those with flexible credit. VA loans require no down payment and are available to veterans and military families. USDA loans also require no down payment and are perfect for buyers in rural areas. Each loan type has its unique benefits, but they all help make homeownership more accessible for those who qualify. Congratulations on taking the next step toward becoming a certified mortgage loan officer. We hope this study guide has provided clarity and a solid foundation for your exam preparation. Remember, success comes with dedication and practice. Stay focused, keep reviewing, and you'll be well on your way to passing the MLO SAFE test. Good luck with your studies, and feel free to reach out if you have any further questions or need additional resources. Stay confident, and you've got this.